How do you know if an imbalance is going to trade only at the high end, or maybe it goes to the low end, or if it's going to go all the way to the lower end and then complete that imbalance to go higher? How do you know? Now, this is why when I taught you guys the imbalance model, or when I teach you guys to trade imbalances on your demo account, I usually tell you, hey, just take the high end. If it goes to the lower end or the midpoint, allow for that. If it goes to the lower end, allow for that. Don't have too tight of a stop. Allow for that. Because I'm basically saying, look, if you miss something, which I'm about to tell you, if you miss something, it's fine as long as it doesn't hit your stop and then goes your way. It's a winning trade. So it's kind of lazy, but the idea here is we also need to look at price action over on the left. Okay. So we need to see, I guess, old structure, if you will. But what we're looking for, and I promise you, you're going to, like this weekend, you're absolutely going to shit yourself when you backtest this. I'm forewarning you now. We had this imbalance on the way lower, right? In a sense, the lows from here, right above my webcam right here, those lows were swept at 7:30 PPI on Thursday, April 11th. So in a very ugly manner, this took liquidity and then traded higher. So should price trade to the high end of this 15-minute imbalance? Should it trade to halfway? Would be a different measurement than the 1 minute. Should it trade to halfway, or should it trade to the lower end? Well, my friends, this is why we have this old imbalance here. We can extend over. You see that? We can extend that over, and now we have confluence right there. So when we take the 15-minute imbalance, that's the halfway point right there. You see that? 18,176 and a quarter. Nothing special about that level entirely. You have an 80 level right there, though. 18,180. I would include that too. But this 15-minute imbalance, it trades to the midpoint, not the lower end. Why? This previous 15-minute inverted imbalances here. It's confluence. And I know I showed this in the market review yesterday, but when you look at this overall, low, high, lower, low, that is a huge, it's kind of stretched, I'll be honest, but that's the highest up close candle on a 1 minute time frame, right? 18,171. Look at that. You thought we were done talking about precision? We're not done. We're done when I tell you we're done, my friends. All the S&P, right? Inverted imbalance, gaps within inverted imbalances. A larger time frame mitigation at the low end of an inverted imbalance, right near the 50% of a 15-minute imbalance, right there. That's the low. And then look at that. That is monstrous. And I'm not even saying along that, but I am saying along that. It's an imbalance that did what? It formed on the way to liquidity. Oh. John, that's the imbalance model, though. You kind of snuck that in there. Yeah. Because I'm giving you models that, and if you're right, will align with price delivery. You just may not know that this was the low because of X, Y, and Z. You might not know this is 15% of an inverted imbalance. But once you get an imbalance that forms in your, like if you're expecting higher pricing and you get an imbalance that forms on the way there, well, that's even better, right? But this is why people don't know why they lose or why they won. You might think, oh, well, I just saw an imbalance on the way to liquidity and I took it and I won. I'm a badass. Okay. Well, you didn't even know you were trading below New York or midnight New York Open. You didn't even know that because you didn't even bother to fucking look. You didn't even know you were in an inverted imbalance. You didn't even know because you didn't fucking look. Because that imbalance model is simply just an imbalance on the way to liquidity. It's simple, right? Because that's just order flow. Post either runs on liquidity or, you know, mitigations and shit like that. That model is basically designed to where you aren't looking for all the things I'm teaching you how to do or what to look for, but you're basically taking the lazy trader's entry to go long. You're like, all right, I'll get in after all this bullshit. Yeah, run liquidity and then I'll get in. That's basically what you're doing. And that's what the imbalance model is. But do you guys see how complicated this stuff can get? As simple as I want it to be, as simple as I try to make it for you, it can get complicated. But that was the low of the day, and it rallied like a monster after that. So that, to me, is one facet. I'll just wrap this up. I don't want to make this clip too long. That is one facet on how to determine if an imbalance is going to get traded only to the higher end, or if it might reach for the midpoint, or if it's going to reach for the lower end. And the reason I tell you guys you're going to shit yourself when you look at this is because it's not just for studying price. What you need to do, as I said the other day, what you need to do is go look at your losses or go look at entries that you didn't get, right? Let's say, for example, you thought this was a mitigation, right? Some of you might look at it that way because you're going, oh, well, that's a low, high, lower, low, the same way that I told you it was, right? And you're looking at 15-minute and you're going, well, shit, dude, I don't understand. I put my order here, or I put my order halfway and it doesn't get to my order and trades higher without me. Now I'm fucking mad because I was bullish and I was right, but I never took a trade. Well, whose fault is that? It ain't the market's fault. The market doesn't even know you exist, my friend. It's because that inversion here, that inverted imbalance is here, and we're already below all of the session opens. How much do you demand from the market, bro? You can't demand, you know, too much. Oh, I want an 88.6 entry. No. What you want is to enter at a place where there is confluence of not just the logic of all the opening prices, not just time, but it's confluence based as well. Fractal low, that could be the next candle entry. You didn't even have to get in down here, but that next 15-minute candle, that could be the next candle entry. Done. There's so many ways to enter a market. You don't have to go down to 1 minute, 1 minute, 5 minute like I do. I love that shit. I love being as precise as I can be. That's just a sport. You know, it's a challenge. I like it. I live for this shit. Okay? But I'm not saying you have to do that. You can trade just a 15-minute time frame and go, okay, well, we hit the whoop-de-whoop, and then I'll just say, fuck it, next candle I'll enter on, stop at this low or even this low down here if you can absorb a loss like that, and boom. Simple. But that's, again, one facet on how you can tell if an imbalance is going to get traded through, to what degree. You need confluence of previous concepts. Time, price, context.